Selling put options is a great way to earn an income from the stock market, especially if you're sitting on $500,000 plus. You can easily create a consistent livable income. But what about if you've got a smaller account? Yes, we can still do it, but we need to have a few tweaks to the strategy. And that's what I want to share with you today, how I specifically sell put options on a smaller account. So what I want to share with you are the exact stocks to trade, plus my secret way to find them. I'll show you the only indicator that you need to enter a trade, what strike to choose, and it's not based on delta. And when a trade goes against you, do you roll it or do you just take assignment? First up, of course, this is not financial advice. This is just what I do. Don't copy strangers on the internet. Do your own research and make your own decisions. Now, before we jump on in, I just want to remind you that the 50K Club is now open. This is the place for options traders to create a consistent monthly income without needing a 7-figure account. We specifically focus on strategies for smaller accounts. And this weekend, I have opened a free trial. So if you want to come and check it out for this weekend only, you can come in for a free 7-day trial. The link is in the description. And this week, we closed out some great positions. QQQ, DRAM, TQQQ, some Soxal trades, all closed out for nice gains for our members. So, trading a smaller account. If you've sold put options before, you've probably heard that it's a safe way to trade because the worst thing that can happen is you get assigned and you just wait it out. Hands up if you're still just waiting it out, because this has been me, right? And I'm here to tell you that when you've got a smaller account, it doesn't feel very safe to just sit and wait it out and see so much red in your account and not have a lot of capital to do anything with. So today, let's cover my number one rule: don't get assigned, right? When I'm selling a put, my number one goal is to not be assigned. So the first thing that I am doing is paying attention to what I'm trading. So I'm only trading stocks that are in a bullish trend. So I'm not selling put options on SoFi, Palantir, Microsoft, Meta, etc. I want a chart to look like this, right? Upwards trend, and not like this, downwards trend. There's two reasons for that. Number one, momentum. Down often equals more down. So I don't want to have a bullish trade, which is what a sold put is. I don't want a bullish trade on downwards momentum. I want a bullish trade on upwards momentum. The other thing is premium. We're here to make money from this, right? If we get assigned stock that's going down, and let me know in the comments if you've experienced this, because I only figured this out myself by experiencing it. You're selling puts, you sell calls maybe the first round, and the premiums are amazing. You're like, this is great. But then all of a sudden, there's no premium left in those covered calls that you're trying to sell. And it's because traders are no longer betting on an upward move, right? In a downtrend, less people are buying calls. That makes sense. The other part to it is more people are selling calls. And that's because we're all stuck with stock that's going in the wrong direction. We want to try to make some money out of it, right? When we were going up, we were happy to hold it. But now that we're coming down and we've been going down for a long time, we're like, let's just earn some income. So there's more people trying to sell calls. There's less people willing to buy them. Therefore, prices are lower. And also what you find is that the room of available strikes is less. So once you were able to, sell a covered call quite far out of the money, you can't anymore. And why I don't like to sell the put when we're in that downward momentum is, again, because of premium. Less people are buying the puts, right? We buy puts when we want to protect and lock in profits once we've had a run up. There's no profits to protect once we're trending downwards. And the other reason why people buy puts is because they're betting the market will drop. Once we've dropped that bet and that gain from betting on that drop has gone. So again, there's less people buying what we're trying to sell. So it doesn't make sense to put ourselves in that market. So how do we find good stocks to trade? Like, we want these upwards trending stocks. One hack that I have is to go and check out the ETF SPMO. SPMO, it's basically the S&P 500's top momentum stocks. So those that are already in this upwards trend. Go and check its holdings, research some of the companies, and you'll probably find a few little gems in there that maybe you've not heard of or that you haven't been trading that meet all of the other criteria on what's a good stock for you to trade. Obviously, in a small account, we're not going to go and put a put option or buy shares for a covered call on Micron, right? That's $1,000 stock. We're not doing that. But some of the others in here will probably meet our criteria. And then when we're entering, now when we enter a trade also determines if we are more or less likely to be assigned. So the indicator that I love to use is the stochastic RSI. Here's how I use it. Quite simply, when it's still pointing down like this, I'm not entering. Why? Because this typically is a measure of momentum. So this is telling me that right now the momentum is on the down. I'm waiting to see, will we get some more downwards days? Because we might, right? I'm looking for the bulk of this move to be over. And rather than guessing when that's happened, I'm waiting for the stochastic RSI to hit the bottom and to start to turn back up. You can see it's happened in this instance here. The stochastic RSI hit the bottom, as did the price, turned back up. Through here, we've had a few little bounces along the way, which would have been fine to enter a sold put position. Same here. We hit the bottom, we bounced. It's that simple with the stochastic RSI. Now, this is not to say that we won't go lower. Right? I want to make that clear. It's not a crystal ball. But when we're playing with upward trending charts and we're paying attention to the stochastic RSI, we can at least with a strong degree of confidence feel like most of the downward movement has been. And that's what I like to look for. I'm not interested in entering on a red day. And if you've been here for a while, you've heard me say that a lot. I don't care that it's a red day or a green day. I care that the bulk of the downward movement has been and that the next most likely move is up, and the stochastic RSI helps me to determine that. Now, what strike to choose? This also will help determine how likely we are to be assigned, and if we do get assigned, how likely we can get out of the position. So I forget delta. I don't even look at delta when it comes to setting my strike for a sold put position. Instead, I look to find a level of support and aim my strike a bit lower. And the reason why I do that is if you do get assigned, you don't want it to be at support. And I've heard people say before, like, choose your strike at support. If that support level gets broken, you will get assigned, and that support level will now become resistance. And we don't want to own stock above resistance, because what does that mean? It'll be harder to get out. Let me show you an example on a chart of where I might like to choose to enter a strike based on support and resistance. So I'm in the chart of GLW. Now, I am not saying that this is the day for entry. I'm just using it for example purposes only, right? If I were entering today, I'm looking for where's the support, and that would be down here at, let's call it 177, 180. And then I'm looking for lower. It's that simple, right? So I would come into the options chain and I would see what premiums I could get, probably at around 170. And I'm either happy with the premium and that risk to reward, and I will take the trade, or I'm not and I won't. But if I'm not going to choose a higher strike just to get a premium I'm happy with. Instead, I'm looking for another trade. If I get this 170 strike and the premium is amazing, I'm like, wow, that's huge. I might choose to take less premium for a safer trade. Because if I can come all the way down to 160, for example, and get a premium that I'm still happy with, then I've made my trade $10 safer. And on a small account, to me, that's oftentimes more important than getting the highest premium. And the reason why I say that is if I enter the trade down here at 160 and it does move straight up, it doesn't mean that I have lost my chance to get the premium that I would have received at 170. Why do I say that? Because I can roll my strike up. So I can start safer just in case it goes against me, and I can always roll this strike up to capture more of the premium that I didn't take in the beginning. I have a whole video on how to do that. I'll link that in the description below if you're interested. But that's how I go about choosing strikes. All right, so we have done everything right. We've entered the trade at the optimum time. We have done all our due diligence, but we will not always get it right, okay? So what happens if our strike is breached? Do we roll or do we take assignment? Now, for me personally, in a small account, I will usually roll because my number one goal in that account is capital preservation. And here's what I look at. Rolling will guarantee me an extra credit because I won't roll unless I can get an extra credit and a lower assignment price. That much is guaranteed. Taking assignment, the only guarantee is that I will own the shares. So when I'm looking for, okay, if my number one goal is capital preservation, then rolling usually meets the criteria best. I want to show you an example, though, of two trades that I had this week, one that I rolled, one that I took assignment, and how I worked that out for each of my accounts. So I'm talking about DRAM. Now, DRAM I had two trades on. One of them is due to expire or was due to expire next week, July 10. One of them expired July 2nd. They're in two different accounts. The one from July 2nd was in my retirement account. The strike was $65. I actually let that get assigned. Here's what I did to determine, will I let it get assigned or won't I? I went into the options chain. Let me show you. And I literally just went out to next week and I looked at, okay, if I get assigned, let's bring in some more strikes. If I do get assigned at 65, how much premium could I potentially achieve if I just sell a covered call at that strike? And right now, it's around 200. I was happy with that. So I thought, you know what? I still believe the DRAM has a lot of room to run. I believe that all of the stocks within this ETF still have huge potential in front of them. A lot of them are undervalued. A lot of them have still predicted doubling their earnings. So I'm happy to own this. Here's the risk though. Right now, we are in an upward momentum like this. Okay. The options chain is really healthy. If we come and look at the calls, we can go out a week and still potentially have $100 worth of premium for the week, all the way up to a $70 strike, which is, call it $10 from where we're trading now. What I know for certain will happen is if we turn bearish on this chart, this premium will dry up really quickly. Look how much volume there is here. This is tens of thousands, probably hundreds of thousands of people betting that DRAM continues to run. When these bets come off the table and there's no longer the demand, this premium will dry up and it will also shrink. So we might go from $3.50 here to $1 and literally start seeing 20 cents from, call it, $63 upwards. This is the part that I was talking about earlier with premiums and how we go from great premiums to where's all my money, right? So that's a risk that I was willing to take inside of my retirement account because I don't get to access that for another 20 plus years. I'm quite confident that I can sit out DRAM for 20 plus years. What I did in my 50K account though, so I had a $65 sold put due to expire July 10. I actually rolled that down to 63 and out to July 24 for an additional credit of $65. Why? I've guaranteed that I received that extra $65 that's sitting in my brokerage right now, and I guarantee that I've lowered that strike. Could I have waited it out? Probably. Will this recover above 65 next week? Maybe. But once my strike's been breached, I like to roll if I'm going to roll because it's easier to roll. It's actually easier to roll before you get breached usually, but it's easier to roll when we're at least around the strike than if we're all the way down here. You know, if we drop to 50, 55, rolling this is going to be a lot tougher. So that's how I make that decision. Typically, I'm rolling in a smaller account and I'm taking assignment in a larger account only if I'm still happy with the underlying stock. If either of these contracts, I was like, I don't think we're getting back above 65 anytime soon, then that's an indication to cut it. Take your loss. Take your loss. Don't continue to roll it. Don't wait it out in a small account. Take your loss. And I think, I can't even remember what the loss would have been. It might have been $100 maybe, right? But that's much better than if we come all the way down to 40 and we can't sell a covered call and we've got $6,500 that we're doing nothing with. So I hope that this video you found helpful. What I will put in the description as well, just for you to download for free, is just simply my cheat sheet of what I'm looking for to sell a put on a small account, what my rules are around that, what these entry criteria were that I spoke about. I will leave that in the description below, as well as, of course, the link to the 50K Club. Free trial for July 4 weekend. Come and check it out. And until next time, I hope that you enjoyed this video. Be sure to subscribe to the channel and I will see you for the next one very soon.